Good morning, everybody. Hope you had a wonderful weekend and the weather treated you okay. Today we're going to start with Jerry because he has let me know that there's a new product in New York, and a lot of the guys on the system, whether you're in New York, in New England, or even in California, have a lot of guys in or a lot of clients in the New York area, and that's usually a really tough market. So we're pretty excited about this new product. So can you bring everybody up to speed, Jerry?
Yeah, good morning, everyone. Thanks a lot, Mike. Appreciate it. Yeah, just like Mike said, I mean, we have great products all across the country, but it's always been a little bit of a challenge. Not, I don't even say a little bit of a challenge, but a big challenge to have product in New York that you guys can use. So, just like you said, whether you're doesn't matter what part of the country you're in, or if you're someone who's right on the back door of New York, you've probably experienced. If you haven't yet, you want to kind of tuck this strategy or idea in your pocket so you have it when you need it. And there's excuse me, there's similar options out there at other states. It's just we basically almost had no options in New York. So I think that this is a very viable option. It's something that can compete, and you can feel really good about bringing to your client that's in New York. So maybe you're someone who used to do some cross-border business, or you had some clients that were in that area and you really couldn't do anything for them or didn't feel good about it. I think this American General solution really fixes that for us. So kind of going through here, want to go through, it's called the Premier Index or the Power Index Premier New York Annuity here. And I want to go down, real simple product, just like many of the growth products. And this is a growth option here I wanted to go over with you guys. I'm going to slide down here. Really simple. They really have pretty much one strategy on it. There's no fees, but it's got an S&P annual point-to-point cap of 10%. So you can't beat that. When you look at the market over the last 100 years, including dividends, it was coming in around 9.5%. So to be able to have an S&P 500 cap at 10%, that really hits the mark for that safe asset allocation that we want in a portfolio. And we get 100% of the market up to 10%. Most of us all know how the S&P 500 cap works. They don't have a ton of other crazy options on the contract, but when you're used to having 3, 4, 5% caps out in New York, going to 10% is absolutely phenomenal on the contract. And one of the things I wanted to show you guys that makes this contract actually a little bit more unique is this. In most states, you have a 1% interest rate on 87.5% of the funds is the minimum guarantee on it, which is cool. We're not really expecting the minimum guarantee to come into play. But because it's New York, they force you to have a higher minimum guarantee, which is why a lot of carriers have a hard time being competitive in there. And AIG, they go under U.S. Life in New York. You'll notice here, they actually have a built-in 2.8% fixed rate on the contract. And what I'm talking about is that's the minimum guarantee, not the interest rate that you can choose on it. That's the minimum guarantee on it. So in this example I have here, I have someone taking a 5% free withdrawal out every year for the rest of their life. We're not getting any earnings here, but just to kind of illustrate this for you, here's $1 million put in the contract on the minimum guarantee value, and you can see the next year it's at $1,028,000. So I don't know if you can see that there, but $1,028,000. That's because you get the better of the two, the interest earned from the S&P cap or the minimum guarantee at 2.8%. So kind of a neat feature to be able to have that, bundling that in and having a decent growth product where you can kind of see here, here's the client taking, assuming we're not getting any interest from the caps. We're just, operating off the minimum guarantee of 2.8%, no fees on it. The client's taking a 5% free withdrawal off it after, 29 years here. They put $1 million in. They got $1,090,000 in income off of it, and they still have an account value of $545,000. So pretty darn good for something that you have absolutely zero risk, and it gives your client a nice option out in that New York area that you can operate in. So this is one of the options they have. It's very simple. Very simple. Like I said, we're talking 10% free withdrawal, a minimum guarantee of 2.8%, and a 10% S&P cap. Doesn't get any easier than that. Now, what you might be thinking too as well is, what's the comp on the product? This is a 7-year contract, and it's 4.25% for the comp, which is probably right in line pretty much for where a lot of 7-year contracts are in the A-rated space. It's maybe a teeny bit lower, but that's because they have to have a little higher minimum guarantees in the contract. But compared to other options that we've had in New York, if you've done business there, that's actually better than a lot of them. It's probably maybe 75 basis points better. So having an option, a good solid option for those people, I think people out in New York are starving to have a great option. So I think you'd show this and it'd be highly, highly competitive. Now, the one other option that they have too as well, I want you guys to see, it's very similar. Same thing. It's the Power Index Premier with Lifetime Income Builder. Well, what's that? This is an income rider. This is literally the only income rider product in New York. So it's similar to some stuff that we have outside of New York too as well that I want to just touch on quick with you. But it's literally the only income rider I know of out there that exists. There may be some obscure product that most people don't have access to out there that has one. I don't know about it. And I don't think most people do, but this is pretty much the only product out there that has an income rider. So you may run into a situation where you have someone that says, hey, typically you got to use SPIAs out there. Who really wants to do that? You lose control of your asset. If you want to take your money and do something else with it, you don't really have any control with it. To have a product where I can get some earnings on it, to have extra legacy for my clients, and then also be able to guarantee an income if I think that kind of having that guarantee makes me feel safer in retirement. Some people are okay, and I think mathematically, if you just took a 5% free withdrawal off, assuming we don't have any risk, you're going to make it, for a long time. It probably will be guaranteed. But a lot of people, and some people, they want to have that feeling of a guarantee with an income rider. They have an income rider on here. And if any of you guys have ever used, say, like a Silac Denali product where they have the no-fee income rider, that's how this works. There's no fee on it. So that's great. We get a guaranteed lifetime income with 0 fee on it. And then they just apply a payout factor to the account value there. And then every year in the deferral, there's 2 ways your income's growing when we're in deferral. The payout factor goes up by 20 basis points. You probably can't see it here, but here's my payout factor at this age 67. And if I were to wait each year, it'd keep on going up by 20 basis points. It's not increasing after you turn it on. Once you turn on your income's locked in, but it's a highly competitive income payout, and it's guaranteed for life. So it's just a way to add that additional guarantee and that great feeling for clients. And you can see here, you're still getting the 2.8% minimum guarantee on here. So we're showing here, assuming there's no interest earned on the contract, you'd have a death benefit until age 86, but the client would continue to get a $68,000 income till the day you die. If you get some earnings in here, by the way, the only thing you give up, instead of a 10% S&P cap, you get a 9% S&P cap. So there is a little something you give up. You just got to have a slightly lower rate, but I still think that's pretty darn competitive. Then if we go down here and take a look and see, all right, if we look at the S&P 500 from 93 to 2022, just see a 30-year period there, what it could have looked like. Well, we ended up getting a pretty nice income of about $2 million down here, 1.9 million over that 30-year period, and still had a contract value of 593. So I think that's for New York, and really just quite frankly, just products out there in general. You could probably take this product outside of New York too as well if you need it, and you'd be competitive. I think it kind of compares to, like I said, a Silac Denali, where you can apply a payout factor to it and get and still have a highly competitive product to be able to get accumulation there for you. I think it kind of slides in there, and you're getting it with an A-rated product. This product doesn't really exist outside of New York with that minimum guarantee, because that's something that they force you to really do in New York. But if you wanted something similar and you like this, I would look at a real similar product would be the Silac Denali, because of the high growth, the free income rider that's competitive out there. But go ahead, reach out if you have some people you want to take a look at. If you have any, if you have clients that are in New York, they have variable annuities, maybe they're sitting in all securities, they got mutual funds. This is something that we want to go out, manage money, whatever it is. You want to go out, talk to them about making sure they're aware of it. There's never been this is just a great time to go out and chat with people on. And quite frankly, probably a lot of people haven't talked to those clients in New York about fixed index annuities, because there really hasn't been too much for options out there. So I'd get out and talk to them and let them know, and go do 21 lights and go show people out in New York, or any of your clients, start writing them down, and go make sure you get out there and show them this new product here from American General. And they go under the name US Life. Actually is kind of the name that they have for there, but it's American General is actually the company. Kind of flipping back to the non-income rider version real quick, if you wanted to see what it would look like taking those withdrawals and you're actually getting the 10% cap. You actually have the opportunity, if you're just taking withdrawals instead of the income rider, where your 5% free withdrawal actually rises a little bit. So kind of a little rising income story if you want there too as well. But yeah, give us a call if you have any questions on it. That's all I kind of had to go over, Mike, unless you had a couple questions to throw at me.
Does the cap change annually, Tim?
Yeah, it's not like any carrier that's out there. No, it's not set up to change annually. But with any carrier, on renewal rates, American General's been pretty good about with their renewal rates. There's multiple things we could get into a conversation about that, but it's not guaranteed to change annually. But they can do that for extenuating circumstances that could happen out in the market. But option, the cost of options could change the cap rate if out there, and that we all know if volatility happens in the market, that can make option prices a little more expensive, which could make it change a little bit. But the reason why these caps and rates are really high at 9 and 10% right now, that's not because it's like a teaser rate. The environment that we're in right now, in a high interest rate environment, they're buying the underlying investments that they're purchasing for these contracts right now pay way more interest. And so they're able to lock in and buy bonds or treasuries paying a higher interest rate. So they have more spread there to buy more options, but thus getting higher cap rates. So a lot of people, just real quick, I can touch on this. I have guys that'll come up to me and they'll be like, hey, I had contracts from 4 years ago. We have interest rates that have risen right now, and how come they didn't raise up those contracts from 4 or 5 years ago? Well, those annuities that were purchased in an environment that was a lower interest rate environment, and the bonds and treasuries that they're tied to are in that lower interest rate environment. So they're the annuities that you purchase, for the most part, are kind of tied to the interest rate environment that you live in. So it's not, hey, they're guaranteed to, if I buy them when they're great right now, we're going to be guaranteed to have rates go down on my renewals if rates go down in the future, and vice versa. If I bought them in a lower interest rate environment, that doesn't mean when interest rates goes up, those products' rates are going to go up. They're kind of tied to the area or the time frame in which they're purchased. I hope that kind of makes sense. If you want to dive into more depth or have some questions on that, feel free to reach out to me. I'm happy to chat about that in the renewal rate strategies of carriers.
Thanks, Jerry. Any other questions? Cool. Well, the one thing Jerry said, I mean, I agree with, is that very few people are probably talking about this now. And if you want an easy sale, you should be the third person to talk to somebody or the first person to talk to somebody. So, and if you're wondering what you can talk to them about, again, if you've done a 21 light with them 3 years ago, 2 years ago, or even 1 year ago, does it make sense to do another 21 light with them? So we say Y or N? Y or N, guys? Yeah, it does. It makes sense to do them all over again, because you should be doing it every year. Every annual review I did 21 light with people, because do they follow through on all the things that you recommend on the 21 light? They do not, but do they appreciate you following up again and making sure that they're always aware of that? They do. So and then after 21 light, this would be an excellent follow-up, letting them know that things have changed and this is available. So that's awesome. Thanks, Jerry.
Yeah, you're welcome.
Let's see here. Okay. So just a reminder, for those of you that aren't aware of this, next Monday is Memorial Day. So we at ECA and 5Q will be taking off. I'm assuming you are also taking off Memorial Day. So just a heads up there. So this is what the market did from 2009 to current, up 310%, an average of a 12.83% rate of return. When do you think we're going to see that again? When do you think we're going to see that again? over a 15-year time period. It'll happen again, but I agree with Kevin, never in our lifetimes, never in our investing lifetimes. So this was an anomaly. Now, here's how you can leverage that. Here's how you can leverage that. Most advisors are unprepared to talk to their clients about anything but this. So anybody are there advisors that got into the business since 2009? Are there advisors that have gotten into business since 2009? Are there a lot of advisors that have gotten into business since 2009? So the only thing they've experienced is what? This. So they think, oh, I'm well versed in market downturns. I'm well versed in market downturns. I'm well versed in market downturns. We had one here. We had one here. We had one here. We had one here. Have they ever seen a market downturn, guys? Have they ever seen a sustained bear market? They have not. And the problem with that is not for their 20-year-olds or 30-year-olds or 40-year-olds or 50-year-olds or 60. Who is it for? Who is the problem with a delay or a extended bear market? Who is that a problem for? What kind of client? Yeah, the people who are retired, Kevin. That's exactly right. So most advisors are unprepared. And even advisors who've been in it 30 years, it's easy to forget what can happen. How fresh is the 2008, 2009, or the 2000 downturns, and even people that have been advising for 30 or 40 years, how fresh is that in their memory and what can actually happen? It's a long time. It's easy to forget that kind of stuff. So most advisors, especially those that started in the last 13 years, they have blinders. They don't even realize what a downturn can do, especially with what kind of risk, guys. What kind of risk can downturns really wield? What's the biggest risk that can be wielded during a sustained downturn? What kind of risk? A downturn doesn't. That's right. Sequence of returns, Nick. And here's the funny thing: CFP board didn't even add retirement income to the curriculum till 2016. So how much experience do most advisors, even CFPs, have with managing people's retirement income? And this is the best case scenario. Here's a CFP with that somebody's been trained since 2016. All those that got their CFP before 2016, have they had any retirement income training? Very little. So if we want to become an expert on something, what would be a terrific thing to become an expert on? Retirement income. And here's the thing: it's not just the fact that we have advisors who come in the last 13 years. It's not just that CFP only recently, relatively recently, began training income. If you look even Google, inflation risk has 650,000 hits. Longevity risk, 425,000. Duration risk, 113,000. Anybody want to hazard a guess on how many hits there are for sequence or return risk on Google? 32,000. It's 5% of inflation risk. Less than 10% as compared to longevity risk. Guys, so how versed are our competitors in retirement income? How much information is there out there for our clients? But if you look at all the surveys, what's the number one risk what is the number one concern retirees have? What's the number one concern retirees have? Running out of money, which is retirement or retirement income. Retirement income. Will my retirement income last? How much can I take? Will that be affected in the future? Do I have is there anything that could cause me to run out of risk? And the number one thing, there's two things. There's two things that can cause people to run out of money in retirement. And what is that? What are those two things? Sequence of return risk. That's one. What's the second thing? That's right, healthcare costs. Of the 5 unique selling propositions or 6 unique selling propositions we have, do we cover both of those risks? Sequence of return risk. Does one of our USPs cover sequence of return risk? Yes, it does. Does one of our USPs cover long-term care or healthcare risks. Yes. So we've got that covered. If you're not using those USPs, guys, you're missing the boat. You're missing the boat. So here's what can happen with bad early sequence of returns with and without annual withdrawals. So if you have a bad sequence of returns, or you start out with a downturn initially, you're fine if you're not making withdrawals, right? You come right back up. In fact, you do not just fine, you do what? Awesome. But if you start taking those withdrawals, what can happen? You can cave very quickly, right? So here's an example. Sequence of returns matters for income. Sequence of return number one is you get a 6% average rate of return. Sequence of returns number two, 6% losses come later. And sequence of return three, you get 6% losses early. So they all have the same rate of return, but they have losses later, losses early. How big a difference can that make? What's in between 24 years and 37 years? If they retire at 60, is that a big or a little difference? Here's another example. We say, well, yeah, but that's if they get it early. Well, here's an example of year one drop, a drop at 15 years, or a drop at the end of the 30-year retirement. How big a difference can it make if they get that drop early on in retirement? Little difference or a huge difference? Big difference. So Vanguard actually has a paper out there. You can actually Google it, Safeguarding Retirement in the Bear Market. So you can actually download this document. It's absolutely free. But obviously, a picture paints 1,000 words. So I just want to walk through some of their graphics so we can get an idea of how big a deal sequence of returns is. And guys, if a picture paints 1,000 words for us, a picture paints how many words for a client? If a picture paints 1,000 words for us, guess how many words a picture paints for a client? Yeah, 1 million, exactly, Michael. So this is giving an example. Sequence of return risk, same generation, 1 year difference. 1 year difference in when they retired. This is the 1973 retiree. This is the 1974 retiree. Guys, 1 year difference. How big is that? Would this be startling? What percentage of clients would be startled by this graphic? What percentage of clients? I want everybody to answer this. What percent of, I agree, Michael, Dale, Tom, all of them would be. And guess what my first question is as a client? What would my first question be as a client? Is there a way I can avoid that? When do I retire? How do I know? What's the difference? Guys, do we have the answers for this to avoid, for a 1973 retiree to avoid being the hazards of this and actually look closer to a 1974? Yes, we do. So outcomes for bear market condition retirees. To quantify the impact of sequence returns systematically, we use monthly U.S. stock market returns since 1926 and identified 8 bear markets. So what they're going to look at is from 1926 to current, they're going to look at 8 bear markets with at least a 20% peak to trough decline to see how would sequence return affect people in 8 different bear markets. Using this definition, we identified 31 years in which our hypothetical investors would have retired during or near one of these markets. We assume that all commenced their retirement at the beginning of the calendar year, so on January 1st. We divided them into 2 different groups. One experienced the full bear market, and the second, only a partial bear market, based on the type of return sequence they would have faced during retirement. For a full bear market retiree, they bear the full brunt of the peak to trough decline. These include most who retire at the market's peak, as well as those who retire in the middle of a bear market. Partial bear market retirees are those who retire at the tail end of a bear market. For example, in 1932 instead of 1929 or 1938, they experienced a generally rebounding market following a short decline. This group also includes those who retire a sufficient amount of time before the onset of the bear market. For example, they retired in 1997 or 98 instead of in 2000, or retired in 2004 instead of 2008. So the partial is either people who retire at the end of a bear market or a number of years before the bear market. Okay, so let's look at what happens here. So here's the 8 different bear markets. Bear market of 1929, full bear market. Partial bear market, they retired in 28 or 1932. The biggest peak to trough was 83% loss. 33 months in that duration. So from September 29th, the trough month of June. So these are the ones that we looked at. The 29 crash, bear market, 37, 46, 62, 68, 73, 2000, and 2008. So the depletion of retirement income under fixed spending. So what they looked at was is how much would their accounts have depleted during a 35-year retirement under two different scenarios, a full bear market versus a partial bear market. So in 1929, they would have what? Lost money or not lost money? Well, the slides, guys, people want the slides. What's the best way to get the slides, guys? We can make them available, and we will make them available. What's the best way to get the slides, guys? Just Google what? Vanguard Safeguarding Retirement in a Bear Market. And then not only do you get the slides, could you hand this document out to clients? Could you go through the document with clients and then just give it to them to send them home? Make sense? So the average for people who went to full bear market, 81% of them depleted their retirement income. With partial, only 50% had a shortfall of income. So look at here. Full bear market, all of them experienced a big depletion in during the 1937 bear market, what percentage of people saw a depletion in their income? So we're reading this chart correctly. What percent of people, if they experienced the full bear market of 1937, saw a depletion of their retirement income? 100%. That's right. 100%, 100%, 100%. Partial in 62, partial in 68 saw 100%, 100%. So this is a dangerous thing or not a dangerous thing for folks? So very dangerous. So what was then? What was the big, what did they see in income? Well, if they started out with 800, they saw their income go down to an average of 737, an average of 665, or average of 586. If they started at 800 and they could only spend 586, does that have an effect on their lifestyle? A little effect or a pretty darn big effect on their lifestyle? That's a huge effect on their lifestyle. Maximum portfolio decline and underwater duration during fixed spending. So if they did not change their spending but kept pulling out the same amount of money, look at how much their portfolio declined. Partial was 82%. The full bear market was 94%. In this particular case, does it really matter whether they'd experienced the full or the partial bear market? How many clients would be say, "Oh, thank God, I only went down 82% instead of 94%"? How many of your clients would be happy with 82% decline? Underwater duration. So these graphs show the maximum decline in portfolio value and underwater duration for hypothetical investors during the near six historical recessionary bear markets. Each investor retired at the beginning of the calendar year with $500,000, 50 in stocks, 50 in bonds, with a partial withdrawal of $25,000. So look at in years the difference here. So underwater duration. So 33 for full bear market, their underwater duration was how long, guys? On average, it was how long? They were underwater for what part of their retirement? Oh, these, no. Is this months or is this years, guys? Is this months or years? So for their entire retirement, they were what? Underwater. For 28 out of their years of their retirement, they were underwater. Either one of those any good, guys? Partial or full bear? Either one of those any good for a client? Oh, you'll only be underwater 28 years of your 35-year retirement. No. ending portfolio value under fixed spending. So again, spending the same amount every year without adjusting. And guys, how many of your clients want to have a retirement where they're going to have fixed spending versus how many people want to say, okay, when the market's down, you got to spend less? How many people want to spend, or first of all, why should they not be spending less when the markets are down? When they're retired, why should they not be spending less? Anybody, give me some ideas. Why should they not be spending less? Why should a retiree not be adjusting their lifestyle? And we're not talking monetary here. We're talking lifestyle-wise. Why should they not be adjusting their lifestyle on a yearly basis? Why should they not skip their vacation? Why should they not skip getting the car they want? Why should they not skip remodeling their home? Why should they not skip giving their grandchild a college education? Guys, I freak out. Time is ticking, Dale. I freak out all the time. I am now 60 to almost 63 years old. And guess what I freak out about every time I see the news? Somebody what? Younger than me, dying. So should they wait to go to that Scandinavian vacation that they've been waiting forever, the cruise they've been waiting forever, to add on and to buy that lake home they've wanted? Should they be waiting? When you're retired, do they have friends, neighbors, or relatives that are dying or getting to the point where they're health-wise they can't do those things? Does that happen to them? Should they be changing they shouldn't. They shouldn't. So ending portfolio value under fixed spending, look at again, full bear market, ending account balance under a full bear market. How many of them never saw or ended up with out of money, almost out of money, 80% down or 75% down? Is that good? How about bear market? Well, the first one, that was okay. I wouldn't have guessed this either. The 29, I wouldn't have guessed that the 29 doesn't look nearly as bad as some of the other ones, does it? But start out with ending balance in hundreds of thousands. Ended up with less than 200,000, about 100,000. These people end up with nothing. So guys, and even so, how about this one? Would people be okay with that one? No. So do we have a solution for these problems? First of all, can we all agree that these are little problems or big problems? And when do we know we're in a bear market? When do we know we're in a bear market? Are we in a bear market right now? Yeah. Do we know how long it's going to last? Yeah, Michael's got it right. We learn we're in a bear market when? After the fact. Because just because the market goes down 20%, does that mean that we're in a bear market and it's going to recover? Just because we've been in a bear market for over a year, does that mean that we're in recovery mode now? When do we know the bear market is over? A year after it's over, 2 years after it's over, or 5 years after it's over? 5 years after it's over. That's when you learn you're out of the bear market. So what's the solution we have? We have the solution, again, thanks to Kitces and Foe. This is a graphic we have in the bond FIA presentation. So let's walk through this. Your chance of success, your chance of not running out of money based on today's stock allocation. So this here, today's stock allocation, this is the stock allocation at the end of a 30-year retirement. So if you start out with zero in stocks and you end up with zero in stocks, so you never have money in stocks, what's the percentage chance you're going to run out of money? Or I'm sorry, not run out of money? You got a 25% chance of not running out of money. If you have 100% of stocks now and 100% of stocks at the end of retirement, you got an 89% chance of not running out of money. But that still leaves what? 1 in 10 are going to what? And guys, when you tell clients you have a 90% chance of success of not running out of money, are most clients happy with that? How many people want a 90% chance of not running out of money? It's funny, some people are saying yes. Guess what my clients always would tell me, that a 90% chance? Yeah, but what? Is there any way we can bring it to a what? They want a 0% chance to run money. They want a 100% chance of success. That's right. That's what they're looking for. And you can see we never do that. But here's the thing. The difference between 89 and 95, guess what? That's doubling, or it's halving the chance, because they went from a 10% chance of running out of money to a 5% chance. So what's happened to their chance of running out of money? They go from a 10% chance to a 5% chance. What's happened to the chance of running out of money? What percentage is it down? 50%. That's right. They've halved their chance of running out of money if they're over here, right? So if I told people if I can halve the chance of you running out of money, how many people would say do that? How many people would want to be able to cut in half the chance of them running out of money? All of them would, exactly. Well, let's look at what we would do then. Well, we would start out with, to be in the dark green here, we would start out with how much in stock today? Between what and what? To be in the green here, we start out between what? What's the least we would have in stocks? 10%. What's the most we'd have in stocks? 60%. And if we want a higher percentage, where should we be? Closer to the 10 or closer to the 60% stocks today? Guys, this is a 30-year retirement. So anybody who's in their 60s, how long, I don't care if they're 60 or 69, how long do they think they're going to live? Another what? If they're in decent health, how many more years do they think they're going to live? Even if they're at 60, many think 30, some think 20, but many think 30. Even at 69, they think another 30. Everybody thinks they're younger than they are, right? So we start out with 10, but then what do we do for the next 30 years? We keep what? What happens is you start putting money back into the market. See, and this is the opposite of what most advisors talk about. Most advisors say the older you get, what? The older you get, the less you should have in stocks. Is that what's happening with this graph? No, it's doing what? It's going the complete what? Opposite. So you start out with 10, and then you start moving higher and higher. So by the time you retire, you got 70%, 80% in the market. So, and why is that the case, guys? Does your sequence of return risk go up or go down as you get older? Does the sequence of return risk go up or go down as you get older? Goes down, that's right. Because if you lose 30% when you're 90, is that going to really affect you as much as losing 30% at the beginning of it when you're 60? No. So starting out with 10 and then moving 10% in the first year, another 10%, another 10%, another 10%, keep moving 10% in, so you got 70 or 80% in the market. What happened to your chance of running out of money versus starting out with 100% or 90% or 70% in the market? What happened? Your chance of running out of money was what? Halved. So starting out with 10% is only half the risk of starting out with 190, 70, or 80. How about 20% in the market and then moving more and more money into the market? Starting out with 30% in the market, moving more and more in the market. And really, that's the best. Where is the darkest green? Where is the highest numbers? It's starting out with how much in stocks? How much in stocks? I don't care whether you're 30 years in or 20 years in. How much in stocks? 30%. And then doing what every single year? Moving into the market. And I've told you many times, I'm going to tell you again, our biggest producers over the last 3 or 4 years followed my direction based on this chart. What did they do? Our biggest producers over the last 3 or 4 years did what over the last, what did they do 3 or 4 years ago? They went to their clients and did what? What did they do 3 or 4 years ago? They went to their clients and did what? They moved They moved their managed money into an FIA, whether it was 80% of the money, 70% of the money, whatever it was. They were in this 20, 30, 40 percentile into left in stocks, and the rest went into. So they were at 80% in an FIA, 70% in an FIA, 60% in an FIA. And guess what they've been doing the last 3 or 4 years? Then moving it back to stocks. Guess how much money they made, first of all? Well, they were our top performers over the last 3 or 4 years. How many of their, and think about this, how many clients have they lost over the last 3 or 4 years with everything's been going on the last year? How many clients have they lost? Their clients think they're what? In fact, I've talked to several of them now that have said, you know, I did this for my clients 3 years ago. They've just inherited another $300,000. They're just retiring. Their wife is retiring, and they got $500,000. Guess what they told the client, the advisor, they want to do? With that $300,000 inheritance or that $500,000 in the wife's retirement plan, guess what they told the client, the advisor, they want to do? Let's put it all into an annuity and then do what? Every year we're going to move 10% out, 10% out, 10% out into the marketplace. And guys, do you get paid up front? Are you cannibalizing your business when you do this? Are you cannibalizing your business when you move from managed money into an FIA? No, you're getting paid 4, 5, 6 years in advance. And then what are you doing over the next 4, 5, or 6 years? Getting paid again by moving it what? Right back into the marketplace. Can you think of any better way than following the directions? And again, Kitces and Foe are the two geniuses in the retirement marketplace today. We should piggyback on their research. Nobody does more research than them. Do we have any better racetrack, any better path than laying out what they've laid out in this graph? And here's the great thing. What's missing from the graph? What we do is actually even better than this. What we do, this number would go up, up, up. It'd be closer to 100% instead of 95%. What do we do different than what this graph is based on? What are they talking about here? How much is in what versus how much is in what? What's this graph talking about? How much is in what versus how much is in what? Bonds. That's right, Ben. Bonds. What do we use instead of bonds? What's going to happen to these numbers if you're using FIAs instead of bonds? We've got tons of proof from Ibbotson. Is Ibbotson an annuity guy or is he a stock guy? Ibbotson, annuity guy or stock guy? And he says you should have how much money in stocks? Or in bonds, I'm sorry, in bonds. 0. Where does he say you should have all your bond money? Why? Because when he looked at all of the research, how much better do FIAs do as compared to bonds? They kick ass on bonds. So what would happen to these numbers? We can even do better than these numbers. We can go from having the amount of chance of running out of money to basically taking it down to 10% chance, instead of 50% less chance, 90% less chance than even being here. Does that make sense? So do you have any better path to follow than what's on, and this is right in your FIA bond presentation. Do you have any better path to follow to make sure people are not hurt by sequence of risk? And guess how much research you have to do? Anybody in this call going to do as much research as Kitces or Foe? Do you know anybody else has done more research than Kitces and Foe? So do you have any better roadmap than this to helping clients with a sequence of return and not running out of money? And also, where are you going to end up with the most money at the end? Not only will they not run out of money, they'll also end up leaving the most money with this. Does that make sense? So if you have not yet adjusted your clients' portfolios to 20, 30, 40% in the stock market and the rest in FIAs, and then have a plan to move that money from FIAs back into the marketplace, guess what you should be spending the next time doing? FO is PFEAU, I think. So if you have not yet done this with your clients, what should you be spending the summer doing? And in fact, I'm going to encourage Jerry and Matt and Dan to ask you guys when they get you on the phone, hey, have you at least considered, not that you're going to do it, not we're going to strong arm you, but have you at least considered this technique? And guys, why would it make sense to use this technique? Well, we got the numbers, but let's talk dollars and cents. Why would it make sense to use this technique? What did I just tell you not 5 minutes ago? Of our top 10 guys, guess what percentage use this technique of moving their money out of managed money into FIAs and a dollar cost averaging back into all of them, all of them, all of them, all of them. So if you want to know, hey, what are your best guys doing? What are the guys doing to make all the money? Guess what they're doing? And now, like I just said, guess what they're doing all over again? They're doing it all over again with new money. Make sense? Cool. This is where you want to be. Your client shouldn't. Your client should have 10%, 20%, 30%, 40%, 50%, no more than 6% in the stock market, and then you should have a plan to move that money back in over time. Sweet spot is that 30% in the stock market, moving that back in time. That's how you want it. That's the best thing for your client. It's the best thing for you. It's a win-win. Make sense? Cool. So today, well, how much time I got? Oh, I got time. So we're going to talk about interest rate risk. So I'm going to jump right into the video here because we got just about enough time to get through that video. So we go here. We do an interest rate. Oopsie. To get out of here and get back to here. Yeah. Okay. So here we go. Exposure to interest rate volatility.
Okay.
And what that talks about is how your investments are set up.
Okay.
So you have in your portfolio, you have both stocks and what?
Bonds.
Bonds. And why don't you just have one or the other? Because they both have disadvantages and they all have what?
Advantages.
Yeah, so should we look at that?
Sure.
So you have stocks and you have bonds. And we said they both have what?
Advantages and disadvantages.
Advantages, and they have disadvantages. So the advantages of stock are what? What do we hope they do?
They'll go up a lot.
Grow, right? That's
Right.
the advantages. And are we in bonds for growth or are we in there for safety?
Safety.
Safety. Okay? And the disadvantage of stocks, anything go up, can what?
Go down.
So it has some what?
Risk.
Yeah. And the disadvantages of bonds is they don't what?
Yeah, they don't make as much.
They don't make as much. They don't make as much. Exactly right. So we're in bonds for what purpose?
Safety.
Safety. And so we need to look at how bonds work. And I use a teeter-totter for that. So I needed him to tell me, do I need to tell them they're in the bonds for safety, or they need to tell me they're in safety? They need to tell me they're in for safety. I mean, how many of your clients invested in bonds for safety? Well, they had a nasty, guys, I told you 3 years ago this is going to happen. And have anybody that invested in bonds had a nasty realization that bonds aren't as safe as they thought they were the last few years? Yes, they have. So the way that bonds work is this. When interest rates go down, bond values go what?
Up.
Up. Exactly right. So vice versa is if interest rates go down, then what direction are, if interest rates go up, what's going to happen to bond values?
Go down.
They're going to go down. So have you ever seen anything like that? When interest rates go up, what's going to happen to bond values? It's the opposite.
Go down.
Yep, and when interest rates go down, they're going to go
Up.
And you might be wondering now, why does interest rates, why when interest rates go down, would that cause them to go up, or when interest rates go up, it would cause them to go down? Can we just walk through why that might be? Okay. So let's say that you decide you're going to buy a bond because they're, again, for growth or for safety?
For safety.
For safety. So you buy a $10,000 bond. Current interest rates in this example is 2%. Okay.
So that would give you how much of interest per year?
$200.
$200. So you're happy, but then the next year, can interest rates go up?
Yeah, they could.
So let's say they go up, just for an example, and they go up to how much here?
3%.
And 3% on 10,000 is how much?
$300.
$300. So that's what the new bonds are priced. Now, for whatever reason, you decide, oh, I don't want this bond anymore. I need the cash. I need that $10,000 to buy a car or whatever it may be. I want to sell that bond.
Okay.
So you go to a broker or you go to your banker and you say, I want to sell this bond.
Mm-hmm.
And they look at it and it's paying what?
2%.
But the going rate is what?
3%.
Do they want your bond?
No,
No.
not really.
So guess what they're going to tell you? We'll buy your bond, but are we going to give you $10,000 for it?
No.
Because it's worth more or worth less at this point? If it's only kicking out 200 when this one's kicking out 300.
It's worth
I would
less.
just
It's worth less, right? So what they're going to say is, we'll buy it, but we're going to buy it for whatever it's worth. So here's how they determine what it's worth. See, the interest they're getting is a full 1/3 less
Mm-hmm.
than what with yours that they could get here, right?
Mm-hmm.
So they're going to multiply $200. I'm sorry, they're going to divide it. They're going to take $200.
Mm-hmm.
So can we clear this
Mm-hmm.
and do $200
Okay.
divided by 3%? And what's that equal?
$6,666.
So guess how much they're going to give you for your bond?
$6,666.
So you start out with what?
Well, 10,000.
Now you're down to what?
66,
So
6,700.
you've lost a third. So what percentage is a third?
33%.
Does that seem like a lot or not?
That's a lot.
That's a lot. So is it risky or is it safe?
Well, it's very risky.
Very risky. So you were sold bonds because they grow, or you sold them because they were safe?
We were sold them because they were safe.
Yes. Now, did you know, if I can find my little, did you know, this is a list, or this is a chart of 10-year Treasury bond yields. Starts in 1790.
Mm-hmm.
We're over here, interest rate wise. So I drew a straight line down across here, because it's showing that have we ever, since 1790, through the Civil War, through World War II, to present, have we ever had interest rates lower than they are right now?
No.
So how much room? They were all the way up to over 15% in the 70s. How much? Almost always are around that 4 or 5 level.
So is this graph still viable even with the interest rate environment we're in today? Should we be using this graph with the interest rate environment we're in today? Very good, Michael. Michael's got it right. Y or N? Y or N? Very good. Everybody's getting it right. Yes, you do. Why? What is this whole thing about? What is our argument we're making about bonds right here, guys? That bonds are good or bonds are bad? Is that the argument we're making? What's the argument we're making? Bonds are good, bonds are bad. Is that it? That is not the point we're making. What is the point we're making here, guys, with the whole interest rate volatility script? What's the point we make with it, guys? It should be a knee-jerk reaction every time I ask you. Knee-jerk reaction. You even think about it. If I said, hey, we're showing that Mars is further from the sun than Venus, why would we do that? You should have an instant. The only point we're ever making with the 21-point checklist is what? No, if they say they're risky, what could they go back to their guy and say, man, these things are risky, what's the guy gonna do? Guys, this should be a knee-jerk reaction. Knee-jerk reaction. What's the whole purpose of every single script we have in the 21-point checklist? That's right. The guy, the advisor said we're putting into bonds. Why? The advisor said we're putting you into bonds for what? Safety. Are you safe in bonds? No. Why did he do that? The whole purpose of every script, guys, if it's to show that bonds are risky, what can the guy do? Move them out of bonds. If the point of the risk script is about risk, they can take them out of the risk. If the point about high turnover, what can an advisor do? If they go back and say, hey, my turnover's too high, what will the advisor do? If all you do is point out the problem, can their guy fix every single problem in the 21-point checklist? I went, yes, sir, and why or N to that? Can their guy fix every single problem in the 21-point checklist? Yes. So is there any, do we gain any advantage by showing them that? And guys, that's when I was making 50 grand a year. I used the 21-point checklist the first year I made 50 grand a year, and I showed them, look, these are all the things that I do and your guy isn't doing. And they said, thanks, Mike. Thanks. If I ever need a guy, I'm coming back to you because obviously you got your head together. And then they took my information, went back to the guy and said, fix all these things. And guess what the guy said? No, I'm not going to. What did the guy do? And took my 21-point checklist back to the guy. This is before I was assigning risk. This was before I was assigning motive, before I was assigning blame. All I did is show them, look at these things that are broken. There's 21 things that are broken. They took it back to their guy, and their guy said, oh, guess what I'll do? I'll fix all 21 things. And then what they do to me? Did they move the money or did they leave it with their guy? They left it with their guy. When I started making money hand over fist, closing 100% of people, is when I quit telling people what was broken in their portfolio. There's only one thing that's broken. What is the only thing that's broken when we do a 21-point checklist? There's one thing and only one thing that's broken. Okay, you're saying their advisor, and what about their advisor? What about their advisor? That's right. Self-dealing, their advisor screwing, the trust is broken. Can their guy fix the fact that they no longer trust him? Is that something he can fix? He can fix bonds. He can fix turnover. He can fix risk. He can get him a better power of attorney. He can do all these things. What's the only thing he cannot fix? The fact that they don't trust him anymore because he withheld information that padded his bank account and hurt their bank account. So guys, in the future, when I ask you, I don't care what script it is, you could be in la-la land daydreaming. You don't even know what script they're talking about, but I say, what's the purpose of their script? Is it the same answer every single time? Their advisor is screwing, my advisor is screwing me. That's what they need to say. If they say that, are they going to move their money to you? Yes. Make sense? Coolio. So the script call, obviously, today will be about this interest rate volatility. Thanks, Jerry, for being on. That's a great alternative for New York. Guys, if please leverage the Kitces graph. It's in our FI presentation, the bond FI presentation. Use this technique to get your clients to move to FIAs and then dollar cost average back into the market. It's good. It's the best thing you do for them. It's the best thing you do for yourself. All right. Thanks, everybody. And then we'll start at 5 after the hour for the script call. Thanks, everybody. Have a great Memorial Day weekend. We won't talk to you next Monday. It'll be the morning, Monday after. Have a great Memorial. Thanks, guys.